differentiates between private and public institutions. We look at the objectives and uses of general purpose financial statement of public sector entities. We look at the qualitative characteristics of public financial statements. We look at the elements of public sector financial statements and their measurement reporting entity. Then we will look at the overview of the regulatory framework, public sector accounting. All these are more of reading and theory. The actual calculation will start, part will start in Unit 2. You know that your first page is going to be centered on Unit 1 to Unit 3. So if nothing at all, you must try to finish with the first 3 units before you write your first page so that you can get the best marks out of it. Before you can do any course, the first thing you have to do is that you have to understand what the course is about or what the title of the course is about. The title of the course is Public Sector Accounting. And these accounting have been prepared by public sector institutions. So you have to know what public sector institutions are. Then from there, we look at maybe their objectives. Then from there, we look at the actual public sector accounting. And we also know the differences between public sector and private sector. You know, private sector people prepare accounts as well. And for the preparation of financial reporting or financial statement, you have done it in your first year where you were doing the introduction to financial reporting or foundation to accounting or introduction to accounting. You've done that where you were being told to prepare the final accounts and also the balance sheet as well as the those accounts. You were being told to prepare all those accounts. However, when you go to level 200, they took you through the various standards that we use in preparing the private sector accounting, that is the international accounting standards, IAS, and IFRS. When it comes to public sector, the way they present their reports are totally different because their objectives are totally different from private sector people. Their way of governance is sometimes different from the private sector. So it makes their reporting approach different from the private sector. That is why they have instituted this course for you to appreciate how the public sector operates. There are a series of public sectors in Ghana. We can have the central government, we can have the MMDAs, that is the metropolitan municipalities and the district assemblies. They are all public sector. Some people do operations, generate money. Others also operate, do not operate, but they get some subsidies from the government in order to fund their operations. Now, let's look at what public sector institutions are. You've heard of public sector institutions, but what are they? What do they represent and what they do? So, public sector is considered to be a section of an economic system controlled by the national, state, or provincial and local government. That is what public sector is about. So it's a public sector institution because it is being controlled by national, state, provincial, and local government. In Ghana, we don't have provincials. So Ghana is being controlled by national, state, and local government. So that is what public sector is about. So anything that is being controlled by the state is public sector. Can you give me some examples of those institutions that are being controlled by the state?
Electricity Company of Ghana Limited.
Ghana Education Service. All these are public institutions, according to the definition that we've stated. Ghana Health Service, they are all Ghana Tourism Agency, they are all public institutions. So in Ghana, when it comes to Ghana, the public sector includes central government, ministries, departments, and agencies. That is the NDAs. The local government units like the metropolitan, we have the municipal, we have the district. At the end of this course, you'll be able to prepare annual statements for all these public institutions and will be able to prepare public statement or financial statement of these public institutions. Public educational institutions like University of Cape Coast, Winneba, KNUST, Legon, they are all part of the public institutions that we are talking about because they are being governed by the state or they are controlled by the state. Quasi-government institutions like public boards and corporations, list of ministries in Ghana, finance, trade, industry, defense, interior, they are all considered as public sector institutions. Why? Because they are controlled by the state. They are controlled by the state. Aside these public sector institutions, there are another type of institutions within the public sector. We call them government business entities. The main goal of public sector institutions are just not to make profits. They are not to make profits, but there are some business entities, though owned by the government, their objectives are totally different from the normal public sector institutions, and we consider them as the government business entities. So the government business entities, they are the public sector and they are in for profit making. They are in for profit making and they have minor hello.
Hi, sir.
Hello.
Hi.
Please can you share the link? Can you share the link on the class page because the police are calling me. Can you share it on the call? Tell them that the class is in session so that they will join. Because when they call, the network drops. All right. I was trying to say that these the public sector institutions that I explained, they are not in to make profits. However, there are some particular business entities that the government is also controlling, but their main goal is to make profits and also render some minor community services. And we consider these people as the government business entities. We call them government business entities. So the government business entities are profit-making entities with minor community service obligations. And usually these are the characteristics. One, they have power to contract in its own name, though it's for the government. However, BCG can enter into a contract in its name. Ghana Water Company can enter into a contract in its name. Ghana Commercial Bank can enter into contract in its name. The National Investment Bank can enter into contract in its name. But Metropolitan cannot enter into contract with his name. When they are doing, realize that they will do the Republic. When they end up in court, it's going to be Republic against any other party because they are not business entities. They are not business entities. So these are some of the characteristics of business entities, government business entity. They have power to contract in its own name. They has been assigned the financial and operational authority to carry on business. So they have the operational power. They have the financial power to enter into to carry on any business that they prefer. To carry on any business that they prefer. And that is another characteristic of business, government business entity. We sell goods and services in the normal course of its business to other entities at profit or full cost recovery. ECG, they don't give us, ECG do not give us the electricity or the power for free. They even add profits on it. When you go to GCB, you realize that when you have money there, they even deduct some money from your account. That is Ghana Commercial Bank. You have NID, they also do businesses profits. So they sell goods and also they render services as their normal course of this business to other entities at a profit or full cost recovery. Also, they are not reliant on continuing government funding to be going concern. So, in as much as they are being controlled by the government or belongs to the government do not send money to them on a constant basis because they are in for profit and they have the mandate to enter into any business that they want. We expect them to sell and render services. We expect them to sell goods and render services in order to generate enough money to take care of the business. So the government will never give them any fund in their operations. So they are not reliant on continuing government funding to be going concern. So their continuation of operations do not depend on the money that will be coming from the government. Then finally, they are controlled by the public sector entity. So they are controlled by the public sector entity. As I said earlier on, they are all business entity. They are all public sector institutions. However, they have been given some mandates in their operations. They have been given some specific mandates in their operations. Please, any questions so far? Please, any questions so far? Okay, if there is no question, due to
That's a question.
how hello. Hello.
Yeah, hi.
If there is no someone said he had a question, but I think she's silent. So even
Yeah,
though
it's breaking.
recent okay, can you ask? Can you ask?
Yeah, so I wanted to find out, based on what you said earlier on, that all these state institutions, they work, let's say, for their own or on their own. So do they pay any money or something to the government, the central government itself? Thank you.
No, they don't. Because it's still on, they are still managed, they are still controlled by the public sector. The profit that they get is for them. I get it. Right. The profit that they make is for them.
Oh, okay. So then what
So
is
the only payment that
SNCD?
the only payment that they will make is maybe taxes. Taxes on the profit that they have made. I get the idea. They will just be, they won't usually, these
Yes.
companies that are listed, these companies that are listed, they also incur a lot of expenses because they have employees that they will pay. They have employees that they will pay. So the money that they have raised, the profit that they have raised is out of it that they are going to pay them. They will pay taxes. The board, these companies, the GBEs usually have a board. We have ECG, board of directors for ECG, and out of this board, if it's a public institution, the government will have a rep on it. All of them are being paid. So they are responsible for the management of the organization. However, it belongs to the government. So you don't have any stipends that will be coming from the government to them. And the government is not expecting them to give them money.
Oh, okay. Thank you.
Even though recent developments in global economy make it difficult for certain products and services to be solely assigned to public sector, the sector is common in certain areas. The public sector provides goods and services in the area of water, power, education, health, security, environmental protection, law, and other. That is why we can't privatize some stuff like education, water, power, health, security, environmental protection. All these are government based in government have decided to take care of them. Also, even though it is uncommon, they still sometimes take over certain services provided by the public sector. Again, the state may also decide to outsource the provision of certain services like sanitation. So in Ghana, realize that sanitation is being outsourced. Sanitation is being outsourced. That is why we are giving it to Zoom Lion to take care of sanitations in Ghana. It was something that was so responsibility of the government that he has outsourced it. That's the nature of the public sector. Now let's look at the general objective of public sector. One of the main objectives of public sector is to facilitate proper administration of state business. That is objective. That is one of the objectives. So governance of a nation is complex. In order for the government to discharge its responsibility well, there should be an appropriate state structure that would facilitate the government's delivery of its mandate. The public sector provides this needed support through the central government and the local. So they facilitate, the public sector will facilitate proper administration of state business. So all the business that belongs to the states, the public sector will see to it that it is being managed and administered properly. Another objective of the public sector is to provide vital services to the state. There are some services that are so vital when you give it to an individual person or private person to provide, they will charge us more than necessary. Example is water. If you give the water service to private person, you might not be paying how much you are paying now. When you give ECG or electricity to private person, you might not be paying how much you are paying now. So the government, the public sector provides these vital services to the states. Important products and services cannot be left in hands of private sector. This is partly because they are key to the survival of citizens. It is risky to provide such services on property some citizens may not afford. These include provisions of water, electricity, health, education. Provide another objective of the public sector is that they provide affordable services. There are some services that if the private sector would have provided, we would have paid more. So what they do is that the public sector will try to give to them, he will provide it to us as subsidized at a subsidized cost. So the state sometimes intervenes in the provision of some services, basically as social intervention, to provide an affordable alternative to the less endowed. The Metro Mass Transit is an example. So you realize that when you are using Metro Mass, you pay lesser than when you are using maybe VIP. That is the provision of affordable services the public sector does. They also ensure the provision of security of the state. You can't give security of the state to a private person. Security is a crucial thing that every government or every institution has to take care, every state has to take it by itself. So that is another objective of the public sector. They also provide employment to the citizens. They bridge the inequality gap. That is, they try to take more from the rich and give it to the poor. And finally, they maintain law and order. So these are the objectives of public sector. So Unit 1, Section 1, we explain what public sector is, and we brought in what government business entities are. Look at some of the characteristics of business entity, the government business entity. And now we looked at the objectives of public sector. Any question?
Yes, please. Hello. Hello, sir.
I'm listening.
Yes, please. Looking at some of the GBAs, you realize even though they are autonomous, they have everything on their own. What normally happens for them, sometimes they call for recapitalization in case maybe they are going to insolvency.
As much as, so that's why I said that the point was that they do not rely on continuing funding from the government. Like the MMDAs, every year, when the government reaches the budget, they apportion some amount to the MMDAs, apportion some amount to the metropolitans and municipalities, the district common fund, for instance, tax revenue go there. I get in the idea. But the GBs will not rely on the government only comes in when there are issues. For instance, recently you realize that ECG, they said that the previous government left a huge debt.
Legacy debt.
The current government came in to pay those debts. It wasn't his responsibility though, but because issue has come, they needed to clear it. It was the ECG responsibility because they entered the contract in their own name, not in the government's name. But the government who came in anytime there are issues like that to bail them out. Any question again? Of private and public institutions, their accounting system. So the similarities, I've explained to you what public sector is, and when you say private sector, it's just those companies that are owned by individuals that are not government, that are not states. So even though public and private sector are different, these sectors have a number of things in common. So they are different though. For instance, Car Bank might be different from GCB, but there are some things that are equal between Car Bank and GCB. Car Bank and GCB. So some of these similarities include the governance. All of them has a board of directors. Governance structure of both private and public sector are largely the same. So when you take the annual report of GCB, which is private, and the annual report of Ghana Commercial Bank or GCB, which is public, compare them, you realize that they all have the governance structure being the same. They all have the board of directors. They all have auditors. they have audit committee, they have um, nomination committee, they have the remuneration committee, they have risk and management committee, they have all the committees. So for public and private sector, their governance structures are the same. Another similarity is the objective. Each of them has a unique objective for which it was established and has a general public or session of shares of their services. So they all have objective. Although public sector might not be interested in making profits, entering special services is a special objective. And don't forget that GBEs are also part of public sector. So though not all public sector might be interested in making profit, but GBEs are in for profit. Every private sector is in for profit. I'm not sure any private person will establish a business without considering profit. Every private sector wants to make profits. So that is also another similarity. Objectives are the same, or they have similar objectives. Now, provision of employment. Car Bank employs, GCB employs, so they all provide employment. They all provide employment. And the last similarity is the record. They all keep records. They all report. That is why at the end of the day, you will get the annual reports for both Car Bank and you get the annual report for GCB. They are all reporting entities. So these are the four main similarities between public sector and private sector. Now let's look at the differences between the public and the private sector. Though I said they all have governance, but the ownership is different. The public sector belongs to the states, or the state who has a majority ownership. Private sector is owned by the private individuals or organization. Car Bank belongs to private person or private. GCB is owned by the government. It's not all public institutions are totally owned by the government. Sometimes they will have majority shares. GCB is an example. When you download the annual report, you will know that huge percentage, maybe 60% of the shares are being owned by the government. The other shares is being owned by individuals or institutions. So they can take huge control of it. NIB can also be the same. So all these ownership belongs to the government, or they have a huge ownership percentage. Private sector, that one there is only for private. When it comes to control also, while public sector entities are controlled by the government and related agencies, private sector entities are controlled by individuals and non-public institutions might sometimes have minimal government interference. So when it comes to control, it's always with the government, with the public sector is being controlled by the government. And the public sector is being controlled by the government. And with the private sector is being controlled by individuals. Now, when it comes to the motive of their establishment, general motive of establishing private organization is for profit. Already told you. Then I said that even though GBEs have similar motive, that is making profit, generally most public enterprises create basically to serve the public at break-even. So they don't charge them because they want to make profits. They only charge them because they want to sell, not to make profits. That is the public sector. Means of funding. Here also, public enterprises are generally funded from the state coffers, with monies from taxpayers and donors agencies as the main source. But private organizations are funded by private citizens who establish them or share in the ideology of those who establish them. Private enterprises are funded through issue of shares and debentures. That is how it's being funded with. Then when it comes to competition, some public sector do not face or they face little competition, while most private organizations operate in. That is how it is. Public sector, I'm not sure anyone can compete with ECG, anyone can compete with NI. You know the reason why GCB do not care about whatever you are doing, they will still charge their normal. As ECG can charge you 500 CDs, like they can charge you 50 CDs every month, yet they will still get people to come and invest in there because they are not in competition with anybody. Have we seen GCB doing a massive advertisement before? So, though they are all in the banking system, but for them, they don't care. So the public sector people, they usually face minimal competition or no competition at all. But for the private sector, their competition there is very huge. Survivor. Survivor is mostly based on politics. ECG will survive based on politics. You remember that the previous government, they said there are some containers within being here where it ended again. So containers were doing those stuff. So their survivor is based as soon as the government changes politics, the government changes, the board chair will also change because the new government will also bring his new board members to come and fill the space. So that is how it's been done. So survivor is a mostly importance of services provided by. So why in private sector is based on the financial success. So these are the main differences between the. Then we also talked about the similarities between them. Okay. We also have basis of promotion of employees. Public sector is predominantly based on seniority, while the private sector is based on an output. So in the public sector, you can never be promoted ahead of someone who came in first. Private sector, if you came in first and you are not performing well, you might not be promoted. The private sector is being based on outreach. Competition in the workplace, the work environment of the private sector is more competitive than the public sector. The public sector, they don't care. If you work in a Dynas application service, you realize that they go to work in time that they used to go. Some instead of going to work at 8, they can go at 10:30. No one cares because there is no much competition. That is the differences between the public sector and the private sector. Please, any question?
Yes, please, can we also add the regulations, let's say the bodies that regulate these sectors?
Having got into the accounting aspect, we are just looking at the public sector as a public sector as an institution. But when it comes to we also look at the differences between the public sector accounting and the private sector accounting. That is why you can bring in the regulation that the private sector accounting is being governed by maybe the accounting standard, the IASs, but the public sector is being governed by maybe the IPSAS. So that is the differences that you can also consider. So here is just a normal difference between the private sector and the public sector. Now, public sector accounting, as the title of course implies, public sector accounting. Public sector accounting. Public sector accounting, the accounting can be explained as the process of collecting a normal accounting definition that you know. The process of collecting, analyzing, you record, you summarize, and interpreting financial information for informed decision by users of the financial information. That is what accounting is about. But when you talk about the public sector accounting, it's a system of accounting used by government officials to systematically collect, analyze, record, summarize, and interpret public sector financial information for users. So what this means is that as accounting, accounting definition is just about you collect, you analyze, you recording. When it comes to a public sector account, you do all these tasks in the public sector. So the definition of accounting in relation to you doing all the systematic accounting processes in the public sector. That is what the public sector accounting is about. So the public sector accounting ensures that public funds are properly accounted for. You are being managed or run, they manage the MMDAs, they are being managed. They use the public fund. The taxes that has been paid is what they use in the funds. If they don't put proper accounting systems, you realize that the taxes that we have paid, they are going to misuse it without giving us justification or proper explanation to it. So what happens is that they have to account for it properly. This involves properly recording government revenue expenditure, assets and liabilities in an acceptable form for proper audit. Also, it is a system that puts in place adequate internal controls for government resources in order to safeguard them. Public sector accounting, also known as the government accounting, is the application of accounting principles to the preparation of the financial records for the government and related institutions for users of public sector. That is what this public sector accounting is about. Now, in Ghana, the public sector is regulated by a number of laws and the international public sector accounting standards that they call the IPSAS. So in Ghana, this public sector accounting that we know is being governed by the number of laws that is the laws we have in Ghana and the international. These regulations define the book of accounts to be kept and how they are kept, audited, reported to users. In some cases, the penalties for non-compliance. So all these are some of the things that we need to know as long as the public sector accounting is concerned. Now let's look at some of the needs for the public sector. Why do you need that it's necessary? Or why do you think that it's necessary for us to prepare public sector? Why is it needed? Or why is it necessary to do the public sector? The first one is that we realize that though the institution belongs to the public or the government or the state, but we have put people in place to look on it for us, to check for everything for us in relation to it. However, sometimes these people will not take care of it for us. So we want to see, we want to report on them stewardship. That is what they've done, whether they are doing the right stewardship job or they are not doing it. That is one of the main needs for the public sector accounting. The second one is that we will also use it to assess the performance of public institutions. Now, when you get the annual report, of government institutions like maybe GCB, based on the profit that they reported, you'll be able to know that, oh, they made a profit or they made a loss. And based on that, you'll be able to tell us the performance of the public institution. It also facilitates auditing of financial statements and projects. So when you put in the proper financial reporting standards or the proper public sector accounting, which when auditors come to audit the books, it's going to be easy because they are going to base it on the approved or accepted standards that we all know. That is what you're going to use. It's also the public sector also we need it for useful decisions like undertaking public investment projects. Sometimes before you can get an investment fund or sponsorship, they will inspect your annual report. And this annual report is generated through the public sector accounting. For economic policy formulation and review, based on the performance of the public institutions, they can help or you can base on it to determine or to develop policy and also review them as a means of sourcing for support from international development agencies. So as I said, for investment, but sometimes if you want to go international, they also inspect your public sector accounting records to also determine whether to give you what you are demanding. Now let's look at the similarities also between the public sector accounting and public sector and the private sector accounting. So let's look at the similarities between public sector accounting and private sector accounting. They both the private and the public, they both keep financial records in order to account for their stewardship. Whether you are doing private approach or you are doing a public sector approach, you will still keep records. You record your generally generated fund, you record. That is a key thing, both private and public. Both public and private sector accounting are based on double entry principle. So they all use the double entry principle. 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 That is every the golden
Yeah, please, we can hear you.
Sir, please, I can't hear you.
Sir, please, your network seems not to be stable.
yeah, can be on.
Yeah,
Hello.
position yourself, so.
You have it. So why can I prove? Can I send it to you now? Okay. Hello, are you there? Can you hear me?
Yeah, we can.
Okay, sorry, someone called. So
Yeah, we are listening, sir. Sir is calling you.
all right, so both the both the public and the private sector accounting are based on a double entry. As I was saying, the golden rule of accounting, which says that the golden rule of double entry principle, which says that every debit entry has its corresponding debit entry. So both the private and the public one, they all use.
Hello, sir. Please, we can't hear you. Sir, your mic is muted.
I carry the. I carry the.
So the data is finishing. Bye bye.
He's on call. Why?
The data is down.
Oh, corporate workers, okay, workers. Oh, about workers.
Oh, he's on call. He will return to.
Please, I'm back. Eh? Can you hear me?
Yes, sir, we can hear you.
Yes.
Okay.
Yes, sir.
So they both form the accounting stress. So they always stress on managing your expenditure so that you don't overspend. Because if you overspend, it will end up affecting the entire profit the organization have made. So both private sector and both private sector accounting and public sector accounting are all concerned about you preparing budgetary and preparing budget and making budgetary controls for it. When government business entities are operated by states, their regulations are not different from the private entities. In other words, they are all required to prepare their accounts following the international standard of financial reporting, the international financial reporting standard, that is the IFRS or the IAS. The international quality of accounting information, they have similar qualities. They have similar qualities. That is the relevance, faithful representation, all they are and good social citizens also. All these entities are expected to be socially responsible so that their activities will not harm the environment in which they operate. Thus, they are required to support or to report their corporate social responsibility activities in what is termed as social reporting. Now, let's look at the differences between the public sector accounting and the private sector. The public sector accounting is an accounting system designed for the government and so that is it. The public sector accounting is being prepared or is accounting system that is for private, sorry, that is for public institutions. Then private accounting system is an accounting system that is for the private. When it comes to objective also, the public sector accounting is designed to serve as a basis for determining position of funds. So the public, when you are preparing some of the final accounts for public sector, you know that you look at surplus and you look at the accumulated funds and those stuff. You will not be interested in capital and all those types of profits that has been made. It's rather they look at the position of funds. While the private sector accounting is meant to determine profit or loss account, profit or loss and also the financial position of the entity. So these are the main objectives, the two different objectives between the public sector and the private sector accounting. The private sector accounts, and as I said, they are for the profit or loss and also the financial position. But for the, they look at for the position of, funds. Now, basis of accounting. Basis of accounting. Even though the international public sector accounting standards gives them the option to adopt either the cash or basis. So when you are preparing the public sector accounting, it's usually based on cash basis. However, the IFSAS gives them option to go for either the cash or the accrual basis. On the other hand, commercial accounting is predominantly based on the accrual basis. The approaches to accounting is that the fund system of accounting is common for the public sector. Then the private sector accounting uses the equity or the partnership approach, which is predominantly used. Then we have capital and revenue expenditure. This one, the public sector accounting does not distinguish. They do not distinguish between capital expenditure and revenue expenditure. But when it comes to the private sector accounting, they distinguish it. So for them, the revenue expenditure will be in the P&L, that is a profit or loss account. Profit or loss and other comprehensive income. But the capital expenditure will rather be in the financial position. And the regulation, so this is where our colleague was asking us that can you use this as a basis? You use it for the differences between public sector accounting and private sector. Another regulations, the public sector accounting is regulated by the Financial Administration Act, regulations, Public Procurement Act, other related public sector accounting laws, and the IFSAS. Finally, the private sector accounting is regulated largely by the International Financial Reporting Standards, the International Accounting Standards, Companies Code, Partnership Act, and other relevant laws. So we have different laws that is governing the public sector accounting and different laws that is governing the private sector. Is any question?
Yes, sir. Please, in relation to the stress you spoke about in terms of their budgetary allocations and budgetary control, you realize that on paper is correct, but practically they do exceed their thresholds. And I want to ask, what normally accounts for that? Thank you.
You know, all these budgets that they prepare, they don't know what will happen in future. We don't know. For instance, we didn't know exchange rate would drop like this. So maybe when they were preparing it, they overstated some stuff or they understated some stuff. So usually things will happen, and when it happens, they will need to call out for more backup, which will eventually affect them. They don't plan of, and mostly also they don't actually put in the right diagnostics or the right listing. They don't do the right computations, the right estimates. So always they try to underestimate them instead of giving us a normal values. You know that in accounting it's always advisable that you underestimate your revenue, but rather overestimate your expenses. But some people will not consider this and just go ahead to prepare the budget. That's why at the end of the day, you realize that they will overspend or do anything of that sort. We don't know what the future holds. So sometimes changes in the policies and changes in styles in the environment will call for stuff like that. So sometimes it's not intentionally, and sometimes people intentionally overspend. Sometimes you realize that even the budget that they decided to use for something,
Exactly.
they will do it, but it will not be up to that budget. But they will try to find something inside to spend the remaining balance.
Okay. Thank you.
So sometimes it's not their fault. Sometimes it's their fault.
Exactly.
Since we are all. Are you okay?
Yes, please. Yes, please. Thank you.
All right.
Yeah.
Now let's look at the objectives and the uses of general purpose financial statements of public sector.
Okay, sir.
Yes, please.
Sir, I'm Steven. Hello.
I'm listening.
Okay, sir, please, I would like to know the IFRS that is required to prepare the account for both public sector and then the private sector, the standard accounting, the national accounting standards.
We don't have a standard that tells us that we can use it to prepare both private and public. By private people, they use the IFRS. All the standards you know from IFRS, IFRS 2, IFRS 1, IFRS 2, IFRS 3, all the standards that you know in accounting, those standards that you did in level 200 during financial reporting. But when it comes to public sector, when it comes to public sector, we use what you call the IFSAS. The difference is that the treatment might be the same. For instance, what IAS 16, which is PPE, will tell you, maybe IFSAS 5 will treat it as PPE. So sometimes they are same. As we move on, I will show you a table that demarcates them. They are the same though. Is that getting the idea?
Okay, sir.
So the IFSAS, we don't have one IFRS. No IFRS. All IFRS are for private sector accounting. Public sector accounting uses the IFSAS.
Oh, okay.
So the full standards under the IFSAS is for the public sector accounting, and the IFRS, all the standards under the IFRS are for the private sector accounting.
All right, thank you.
Man. Felicia.
Let's look at the objectives. Let's look at the objectives and the uses of general purpose.
The network, is it from inside or the whole class? Because I find it difficult to know what it says.
Sure, from the search.
So objectives and uses of general purpose financial statements of public sector. So as I said, the public sector has their own way that they prepare it. They use the IPSAS, they use the various laws in the company's code or the laws in the public sector, in the Government Act and all those stuff. So that is what we use in the preparation of the financial report. Now let's look at some of the objectives and the uses. And this will be based on the conceptual framework. So conceptual framework will give us the framework of how the accounts will be prepared. And under the conceptual framework, it gives us the concepts of the presentation and preparation, or the concepts of the preparation and presentation of final accounts in the public sector. Under the conceptual framework, it gives us the objectives of the general purpose financial report. And the main objective is that the overriding objective of the financial reporting to users is to facilitate accountability and decision making. So if you go to exam zone, they ask you that what's the general purpose financial report is to facilitate accountability and decision making. That is the main objective of the general purpose financial report. General purpose financial report is to facilitate accountability and decision making. Accountability is where
Sir,
citizens,
sir,
yes, please, yes.
people's mics are on and they are doing noises at the background. It's disturbing the class.
Okay, please kindly mute yourself. Everyone should kindly mute yourself, please. All right, you only unmute yourself if you want to stop. All right. So accountability is where people show responsibilities assigned to those in charge of the management and governance have discharged within the mandate. So accountability is where you show that, oh, you've done what you're. So accountability, you've given us, you have given them stuff to keep for us. We have given them stuff to take care of it. So they will come and give us accountability. We have to be accountable for whatever that was handed to them. And also decision making based on the annual report or based on the financial statement that will be released. We will use them to make decisions. So users of general purpose financial reports need the financial information for useful decision making. That is the main thing. For instance, if the government should continue to pay the debts that has been paid by ECG, it will be based on the annual report or the financial statements. When it comes to the users or users basis for accessing sectors entity, public sector entity, information provided by the general purpose financial reports to users are basically ability and decision making within the framework of the objective of establishing public sector, which is more public service oriented rather than profit making motive. As users assess PSs by, so they assess it by one, considering whether the PSE provided a service to constituents in a cost efficient and effective manner. They ascertaining the resources currently available to meet future expenditure and extent restrictions. So some of the decisions that they use it for is what as follows. Ascertaining the extent to which the burden of future year taxpayers of paying current services, and finally considering whether the entity's ability to provide services has improved or deteriorated. When it comes to the users, the actual users of these GPFR, that is the general purpose financial reporting, the main users include the resource providers, that is those who provide resources to be used by the public sector entities. If you are a donor and you give money to them, you give money to UCG, you expect them to use the money properly. So you always be checking the reports that they generate to see whether they are using it wisely. Then we have service recipients. Those who are receiving services from the public sector also need the information. They need to use the information for their own sake. Representatives of services recipients, such as the legislature, including member of parliament, that is, since parliaments are responsible in decision making in those tasks, they are also interested in using the reports provided by the public sector. Then other parties, including government, statistician, analysts, all these people are also, they want to use the statement that is provided by the public sector. Then entity management, regulatory oversight, and the rating agencies. These are all responsible. So as I've already explained, information needs of service recipients. When you read this, you will know the kind of information that they need. Service recipients also, there is a specific information that they need. Then specific information requirement for resource providers, information needed by the general purpose, or the general purpose financial reports, information provided by general purpose financial reports. We provide financial position. Financial position, that is the resources and claims. You provide them financial position, you provide financial performance, cash flow, non-information, non-financial information. When you provide all this information, it covers the general purpose financial reports. So the financial position is like the balance sheet for the private sector accounting. Financial performance is like the profit program, the statement of profit or loss account, another comprehensive income. The cash flow is normally the cash flow statements that you know, that the non-financial information such as the compliance with approved budget, service deliveries, activities, and all those stuff. We also prepare budget and compliance with legislation. They provide services delivery achievements. They provide prospective financial notes. So all these are some of the informations or the accounts that the general purpose financial reporting provides. Now let's look at some of the basis for public sector. When we're trying to explain the differences between the public sector accounting and private sector accounting, we realize that we stated that with the public sector, they are expected to use the cash. But the IPSAS gives them the option to go for either the cash. So because we are using IPSAS says that you can use the accrual basis. Accrual basis simply means that when it's accrual basis simply means that you will accrual basis means that you record transaction as and when it is incurred, not when money comes in. So the accrual basis of accounting is with the assumption that transactions are recognized when they occur and not when they are paid for. That is accrual basis. And the cash basis is where cash, you only record transaction when cash comes in. So these are the two main assumptions or basis for accounting: accrual basis and the cash basis. The accrual basis. So you can look at this illustration, which is described or which differentiated between the accrual basis and the cash basis. So when you are doing to realize that BA district assembly is in business or less during festive to support this. During the last Christmas, 31st December 2017, the district sold 1,000 beds for 25,000 cities in total. Out of the 1,500 beds had purchased 20 cities each. All transactions were for cash. Show how the income statement will look like. So this is just a normal computation that they do using the cash basis. The cash basis and the accrual basis. So we are selling 1,000 beds. So 1,000 beds for 25,000. 1,000 beds we purchase 20 cities. So the purchases is what varies to the same thing. When you are using the cash basis, there is no closing inventory. Hello.
Please, are you at the calculation and put your tax process?
Calculation, this is say it's not that important now because we are just trying to describe the differentiate between the accrual basis and the cash basis. It's just normal. I've already explained that when you enter into a transaction, that does not, when you are using the accrual basis, we only record cash stacks. Like we only record the transaction when it occurs. So if the transaction occurs, we record not when cash comes in. Not when cash comes in. But with the cash basis, we only record transaction when cash comes in. So let's look at this example to explain this. So there is a district assembly. You know, district assembly is a public sector institution. The business they are buying beds, the festive occasion. So they are saying that during last Christmas, 31st December, the district sold 1,000 beds, 25,000 cedis, out of 1,500 beds we purchased. So they actually purchased 1,500 at 20 cedis. So 1,500 times 20 cedis is the purchases cost. That is why they did purchases here. Have you seen it?
That's our
1,500 times 20 cedis. Because that was how much they bought it. 1,500 times 20 cedis. Yes. So that represented the purchases here. The 30,000 was 1,500 times 20.
Okay, sir. Closing stock.
They sold 1,000. They sold 1,000 here for 25,000. So that one will be the sales. That's why you see 25,000 here.
Yes.
Okay, sir.
That is the sales. When it comes to the closing stock, we purchased 1,500 beds. We've sold 1,000 beds. So we have left with how many beds in our books? 500 beds. And each bed costs 20 cedis. So when you multiply these 20 cedis by the remaining 500 beds, you get 10,000.
Take it from.
I think that's the idea.
So,
all right. So now, when you deduct this 30,000 from this,
no, you got the 10,000 from the 30,000.
So 30,000 minus 10,000, you get a cost of sales of 20,000. You deduct it from this 25,000, you get a profit of 5,000. That is how we do the accrual basis. With the cash basis, because closing stock will not bring us cash, we don't record closing stocks when we are dealing with cash basis. We only record transaction that comes with cash. That is why cash basis, it was only sales, the purchases that they made. There was no closing stock. So when you deduct this 30,000 from 25,000, you will get a loss of 5,000 cedis. So that is the difference between the cash basis and the accrual basis. We don't really need cash. When you are dealing with cash basis, there is nothing like closing stock. Please, can you mute yourself?
So please, I can't hear you well.
Can you hear me now? Someone was talking behind, so I needed to mute him. Are you okay now?
Yes, please. But the explanation is not that clear to me.
Okay. Let me take it again. The company pitches 1,500 beds. They pitches 1,500 beds at 20 cities. Please, are you following?
Yes, please.
Hello.
Hi.
Are you
Yes,
following?
please.
Yes, please. Yeah, we see.
Yes, please.
Okay. So they purchase 1,500 at 20 cities. So it means that their purchases that they made was how much?
1,005 by 20. That was 25,000.
1,005 by 20.
That'll give 25,000.
Let's multiply it and see. That's 1,005 times 20. What will you get?
25,000.
Are you sure?
No, 30,000 rather. Sorry. 30,000.
30,000. So 30,000 is our purchases.
Yes, please.
Then out of these purchases, the 1,500 that we sold 1,000 beds, and we sold it for 25,000 cedis. So these beds that we are selling is what you call the sales that we have made. Are you getting the idea?
Yes, please.
We purchased 1,500. We've sold 1,000. How many beds are left?
500.
500. So when you are using the accrual basis, you consider this closing inventory of 500 beds.
The cost of 10,000.
So you multiply it by 20 cedis to get 10,000 cedis. So this closing inventory, the normal presentation that you know in accounting, sales comes 25,000 less cost of sales, which will start with purchases of 30,000. Then we will less closing inventory, which is 10,000. So if I deduct this, I will get 20,000 here, right?
Yes, please.
This will give me 20,000. Then when I less it from the sales, I will get profit of 5,000. This is the accrual basis. This is accrual basis. This is accrual basis.
Okay.
Now, when it comes to the cash basis do not consider non-cash, like stuff that do not bring cash. And closing stock, when you say closing stock is not part of cash. Closing stocks are stocks. So for them, you only record the sales of 25,000 and the purchases that they made. So the difference between the two will give us negative 5,000. That is why the cash basis gave us a negative 5,000. Then the purchases, the accrual basis gave us a positive 5,000 because the accrual basis considered the closing stock, but the cash basis didn't consider the closing stock. So that is the difference. Please, are you okay now?
Yes, please. To me, I'm okay though. No one calls.
Okay. Any question? If there is no question, let's move on to the qualitative characteristics of public sector, qualitative characteristics of public financial statements. This also falls under the conceptual framework. And when we look at the qualitative characteristics, there are a series of qualitative characteristics, and one of them is the relevance. Relevance. When you say an accounting statement or financial report, financial information is relevant. There are key things that you have to consider, and these key things include that the information must be able to give us two things, must give us a confirmatory value and a predictive value. That makes it relevant. It must give us a confirmatory value and a predictive value. Confirmatory value means that the financial information confirms or changes past or present expectation. So it will confirm to us the statement that we got previously. So it confirms past information. Then predictive implies that the financial information is capable of assisting users to forecast economic conditions. That is a predictive. It has a predictive value. It has a predictive value. Then the second qualitative characteristic is the faithful representation. The faithful representation also has three things that comes together to form faithful representation. It has to be complete. The information has to be complete. The information has to be neutral. That is no bias. The information has to be neutral, no bias. Then the information has to be free from material error. So these are the three bases that will fall under the faithful representation: complete, neutral, and free from material errors. Then we have understandability. The information must be comprehended by its users. So the users have to understand the information, the financial information. And timeliness means that another characteristic is timeliness. It must be provided within the time before it loses its value. So time-wise, if they are done with the annual report for 2020, you give us a reporting for 2020. You don't give us, or you don't wait for 2 years before you give us a reporting of the statement. Then we have comparability. That is the ability of the report to be, you can compare the report to other company in the same industry so that you can take decisions. So the report that GCB will provide to us, you must be able to compare with Carl Bank or Prudential Bank because they are all in the same industry. Because they are in the same industry. Then verifiability. Verifiability is a quality of accounting information that helps users to confirm or validate the authenticity of the transaction that have taken place in the PSC or are reported to have taken place. So that is what the verifiability implies. So any information the financial statement will provide to us, we must be able to validate and also confirm its values. Now let's look at some of the constraints on information included in the GP, that is the general purpose financial reporting. Materiality. The materiality is one of the main constraints. That is information material if it's omission or miss. Information is material if it's omission or misstatement would influence the discharge of accountability by the entity or the decision that users make on the basis of this entity prepared. So usually we don't know the information that is material and information that is immaterial. So it serves as a constraint. So we don't know whether it is material or immaterial, depending on. Based on this, it serves as a constraint in it and also cost benefits. The preparation of financial and non-financial general purpose financial reporting involves costs and must be justified by its associated benefit of accountability and decision making. The cost of generating this may not commensurate the expected benefit in terms of expected quality of the GL. So another constraint is also the issue of cost and benefit analysis. So sometimes you know that the cost that you incurred in doing something, the benefit must overcome, or the benefit must be more than the cost that you have incurred. However, we don't get the same thing when it comes to the financial, the GP, the general purpose financial reporting. You don't get the same thing. So it makes things difficult, or it serves as a constraint for us. So these are the qualitative characteristics and also the constraints in this GPS. Any question, please? Any question? If there is no question, let's move on to Unit 1, Section 5. We have 20 more minutes, so any place that we get to, we'll just continue from there next week. What time am I supposed to close?
It's 11:30.
11:30.
7:30.
Let's try to do. I'm not sure we can finish the Unit 1. Like we can finish the Section 5. But let's do any place that we get to, we just stop. Now let's look at the elements of public sector financial statements and their measurements. Elements. But before you do the elements usually are 5. We have the assets, liability, equity, and assets, liability, equity, income, and expenses or expenditure. So these are the main elements. But before you talk about the elements, you have to talk about the reporting entity. The reporting entity refers to the firm or the government or other public sector organization that prepares the general purpose financial reporting standards. That is a reporting entity. That is the company that is going to report. Please, any question? Okay. Someone raised their hand, so I thought you had a question. So the reporting entity is the institution that is preparing the annual statement. In this case, since it's a public sector institution, a public sector accounting that we are doing, the reporting entity is usually the government or other public sector organization, program, or identifiable area of activities or activity that prepares the general purpose financial reporting standards. Key characteristics of public sector reporting entity is that it is an entity that raises resources from or on behalf of the constituents or uses resources to undertake activities for the benefit or on behalf of those constituents. So the reporting entity is usually the ones who raises resources, or they do it on behalf of another person. There are services, recipients, or resources provided dependent on GPRS of the entity for the information. There is also a key characteristic of the reporting entity. Then when it comes to the elements, the actual elements of the financial statement, I say we have assets. It's the same definition that we have during your financial reporting. So they are saying that assets, they are resources presently controlled by the entity as a result of past events, and of which future economic benefits are expected to flow into the organization. That is what assets are. So any economic resources that is controlled by the entity as a result of past events, and any item with services or potential and ability to generate future economic. That is what assets is about. Then the other element of financial reporting is liability. And the liability, opposite of assets, like a present obligation of an entity, is a present obligation of an entity for an outflow of resources that result from past events. So it's the present obligation, what you owe. So what you are owing them, the present obligation could be legal or constructive. In the public sector, obligation may rise through making political promises such as an electoral pledge, announcement of policy, introduction of budgets, which may be two distinct points in the budget becoming effective. Normally, the early stages may not give rise to the present obligation as the later stages. So these are what liabilities are. Second element of financial statement. So we've talked about asset being the first, liability being the second. Let's look at the net financial position, which in the private sector they call it equity. The net financial position is just the differences between the assets we explained earlier on and the liabilities. After adding other resources and deducting other obligations, recognize net financial position. That is the third element of financial reporting or the general purpose. Now the next one is the expense. Sorry, the next one is the revenue. The revenue refers to an increase in net financial position of an entity rather than increases arising from ownership contribution. So anytime the net financial position of the firm increases, which comes aside the ones that the owners will contribute into the organization, we consider them as expenses. Then we call them as revenue. Then expenses is where is the opposite of revenue, where the net financial position of an entity decreases. And this decrement is not as a result of ownership distribution. So like when you are giving out money to owners of the organization, we don't consider it as an expense. It's only an expense when it goes beyond owner's distribution. The another thing that you have to know is surplus and deficit. Surplus is the differences between the revenue that we have explained and the expenses that we have explained. Ownership contribution to refers to the inflows of resources of an entity contributed by the external parties in their capacity as owners. So if the owners of the organization give out money, we consider it to be revenue. We consider it to be ownership contribution. Then ownership distribution is where the organization decides to pay out or distribute money to the external parties in their capacity as owners. So these are all key elements of the financial statements. These are all key financial elements of the annual report on the financial statement. Now, recognition criteria and their relationship to disclosure. Yes, no, isn't being recorded. Okay, yeah, they are recording it. So recognition criteria and their relationship to disclosure. So we have explained all the various elements that you need to know. We've explained the elements that you need to know. However, we have to know how they are being recognized and how we are going to disclose them. That is a disclosure. How are you going to disclose them and their recognition? So the recognition criteria are that an item satisfies the definition of an element, that is either an asset, liability, net financial position, revenue, expenses. In some circumstances, a resources obligation may be allowed by the IPSAS to be recognized, even though it does not meet the definition of an element, provided it can be measured in a way that achieves the qualitative characteristics and constraints. So the first thing is that it has to satisfy the definition of an element. But if it doesn't, sometimes the IPSAS, that is a standard, also allow us to recognize it or to disclose it if it can be measured in a way that achieves the qualitative characteristics. Then also it can be measured in a way that achieves the qualitative characteristics and takes account of the constraints and the information of the GPF RS, that is the materiality and the cost benefit analysis. Now, Disclosures and recognition. Disclosures cannot be used as a remedy for failure to recognize transaction that meets the definition of the element. So you can't decide to recognize something and say, oh, I've disclosed it. No. If it's an element and it's material, can you recognize it? But disclosures can be used to offer explanation for the transaction that meets the significant, but not all that definition of the elements of the financial statement. So sometimes there are some items that you cannot measure reliably. For those items, though, they can fall within the elements of the financial statement, but you can't measure them reliably. Then that calls for disclosure. So you can just disclose them. Then the derecognition is a process of evaluating whether changes have occurred since the previous reporting date that warrants removing an element that has been previously recognized from the financial statement. So sometimes you record maybe an asset, a car in the books. A car in the books. Will be a motor vehicle, you have recorded it as an asset in the books. But as time goes on, you realize that the asset or the book, the car is no more. So you have to derecognize it from the books. That is what the derecognition means. You're trying to take off an asset that was recorded previously in the books, and now it is no more. So when you decide to take them out from the books, that is what the derecognition implies. Now let's look at the measurement of assets and liabilities in financial statements. You realize that we said that all the elements must be measured reliably. All the assets must be measured reliably. And how are you going to measure these assets and liabilities? And the measurement basis selected facilitates the achievement of by enable users to assess the cost of toll. We do all these measurements so that we want to know the cost of services provided in the period, in historical or current terms. So we want to measure assets because we want to know the cost. We also want to measure these elements, that is asset liability, because we want to know the operational capacity and also want to know the financial capacity. Now, when you are doing measurement also, there are things that you need to consider. That is the measurement basis and their selection. The measurement basis and their selection. And the first measurement basis and selection is the entry and exit values. Entry and exit values. That is, the entry values are the values at which the asset is initially recognized in the books. So when you buy an asset now, how was it or how much was recorded at the initial or when it was first brought in the books? How much was it? Then the exit value will refer to the values at which the assets were recognized from the books. So you can buy an asset for 30,000, but when you were removing it from the books, it was around 10,000. So that one is also a measurement basis. The framework identifies these values with respect to assets and liabilities. So this entry and exit values is for assets and liabilities. Now for assets, entry values of assets reflect historical replacement cost of the asset, while the exit value reflects the economic benefit from disposing of the assets. So the entry value is how much you bought the assets. Exit value is how much you sold the asset for. Basically, that is what this means. Liability also, entry values of liability relate to the transaction that which an obligation is received or the amount that an entity would accept for assuming the liability. So that one also, when the entry value is how much that was paid, how much they paid when they were doing the transaction, which will lead to the present obligation. That will lead to the present obligation. Then the exit value reflects the amount required for fulfilling an obligation. So though we were owing 10,000 cedis at the beginning of the year, by due to inflation and other stuffs, they have agreed to take maybe 20 cedis. So the exit value will be the 20 cedis because that is how much you're going to use to pay off our debt. Then the obligation, the entry cost will be how much that came in that we actually own. Now let's look at observable and unobservable. Observable means
the valuation methods are likely to be more understandable and verifiable, or may be more faithful representative of the phenomenon than unobservable. They will also consider the entity-specific and non-entity-specific also, where the entity-specific values reflect the economic and current policy constraints of that affect the possible uses of the assets and the settlement of the liability by the entity, while non-entity specific reflects general market opportunities and risks. We have measurement basis of assets, that is the historical cost, market value, replacement cost, net selling price, and value in use are the measurement basis identified for assets. Historical, we have the consideration given to acquire or develop an asset, which is the cash or the cash equivalent. So the measurement that we are going to use, one of them is the historical cost. We're going to consider the historical cost. We consider the market value, the replacement cost, and the net selling price. Value in use. These are the measurement bases that we use for an asset. So historical cost is where you consider how much the asset was bought at the initial stage. That is a historical cost. Current value measurement is the economic environment prevailing at the reporting date. So for instance, you bought VIX 2020 and the cost of the VIX was 25,000. By when we look at economic improvement, VIX is maybe around 80,000 Ghana cedis. Based on that, you can use that current value as a basis of measurement for the asset. Then the market value also falls under the current value measurement, where an amount of which an asset could be exchanged within knowledgeable willing parties in arm's length transaction. So an asset might be 10,000 cedis to, but reasonable people can enter into a normal transaction and decide to pay maybe 500 cedis. That becomes the market value of the asset. Then the replacement cost is also the most economic cost required for an entity to replace the services potential of the asset. So when the asset that you are using, there is a replacement. If you want to replace it, how much you are going to spend before you replace it? That becomes your replacement cost. Then we have the net selling price. The net selling price is the amount the entity can obtain from the sale of the asset after deducting the cost of sales from it. Then the value in use is the present value of the entity of the asset, remaining services, potential or ability to generate benefits if it continues to be used. And then so in the value in use is where they calculate the present value of all the future inflows the assets are likely to provide. So this table gives us a summary of the measurement basis of it for entry or exit. So you just read through and just go through. Now, when it comes to measurement for liability, that one is uses historical cost, cost of fulfillment, market value, cost of release, and assumption cost. And they have all been explained under this section. Historical cost is a normal historical cost that we did under the assets. The cost of fulfillment, this is a cost that the entity will incur in fulfilling the obligations represented by the liability, assuming that it does so in the least costly manner. Then the market value is the amount for which a liability could be settled between the knowledgeable and willing parties in an arm's length transaction. In an arm's length transaction. So these are the key things that you need to understand. Cost of release and assumption prices is self-explanatory. That is a term used in the context of liabilities to refer to the same concept as net selling price in the context of assets. So it refers to the amount of, that is a net selling price that I explained to you during the assets. The net selling price, as I explained. The assumption price is also in the concept, the same as the concept of the replacement cost in the assets. So these are the things. So the assumption cost is the replacement cost in assets. Cost of release is the net selling price in the assets. Market value and cost fulfillment. So basically, this is what you need to know under the public sector accounting. Next week, we will look at the overview of the regulatory framework. That is all those regulations that governs the preparation of the annual or the public sector accounting. We look at some of the acts, the relevant provision, the constitution, the public funds, and all those stuff. We look at all of them. When it starts now, we won't finish. That's why I want to push it to next week. So that next week, we use the first 25 minutes or 20 minutes to clear all these before we move on to the unit. Please, any question? Any question? Hello?
We are here. No
Hi.
question.
We are okay for now.
You guys scared me. I thought you were not there and I've been talking, sir.
No. We are with you.
Okay. All right. If there is no question, then I think we can close the class. Then next week, the same time, 9:30 Sunday, we also take it from there. Thank you for your time.
Of course, I will get it.
So
First one, I think you get it from yourself.
Are we going to get a recording?
They will share the recording.
I didn't hear about the court model. So how are we going to get it? I didn't hear about that, sir.
That you said for the recordings, they will share it with you. And we have to create a page for only public sector students, like those within the center. So I want the course reps to send me WhatsApp message so that we will create a link, then he will share it with the group. So when you go to the link that is shared with you, where you selected a link, my number is there. So you just send me WhatsApp. The course rep should send me WhatsApp message.
Course rep, please add me.
And you just share the link with the various groups. So for the models, someone asked for the models. Models, don't you go to the centers again?
So we go to the centers, but they put the models, they put the soft copy. They give us the soft copies. We don't have the hard copies. And
Some of us have
the
hard copy.
Some of us
So
don't
I think
have.
the various centers, they brought it this weekend and maybe it wasn't enough. So maybe next weekend they will bring it. But let the coordinators be aware that you didn't get the models because they have printed all the models for all the courses that you are doing right now.
Okay, so
Someone
I want to
also
give a suggestion. Next week when we meet, kindly get a place with a good network that we can all hear what is going on. Some of us, the thing breaks and then it comes. Then your voice has been shaken. The network is not
really?
Yes, it's not so good at your end.
Please, which center? Which center?
I'm from who? How do you call this place? Sokode.
Sokode. Okay, please assign Sokode. Anyone experiencing such issue?
Yes, Botek, that's Bogatanga, also experiencing.
Assign Botek
and NG2.
NG2. Okay, all right. So well noted. Next week I will see whether I will use an actual internet connection for this class. I'm sorry about that, but I hope you got something.
Sir, please,
yes, please.
STU center parts. STU
is supposed to be. The STU is part of this class.
Okay, thank you very much.
STU DM me, okay? STU DM me.
Oh. All right. So if there is no other issue, so next week I will use the actual internet connection to see whether we are still going to have. I'm sorry that it was breaking like that.
And so there's one more thing. The way you were running, the the speed at which you were going was just somehow, boss.
Oh, okay.
Yes.
So that's why
Relax more.
I'll usually when I started, I was very calm. I came back to be asking you questions and other stuff. Okay. So next time, well noted. This is just the beginning. So I'll look at it and get back to you. And like I will reduce the speed that I go with it.
Okay, thank you very much.
You're welcome. Please, any other issue again?
Grateful.
Okay. So if there is no issue, then I think we'll call it a day.
Thank you. God bless.
Thank you. Have a nice day.
Same to you, please. Thank you.
Fidel.
Yes, sir.
Yeah, this is Steven.
Okay.
Yeah, after this session, let's have a private communication.
Okay, sure. Thank you.
Are we done for the day?
Please, group admin, please add me.
Please, who is that?